Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. I am Austin Wilson, research analyst at Hicks & Zerker Capital Management.
And I'm Josh Robb, director of wealth management at Hicks & Zerker Capital Management. Austin, how can people help us with our podcast?
We would love it if you'd subscribe, if you're not subscribed, so you get new episodes when we drop every single Thursday. Hit that plus, follow, whatever that button is on your podcast player so you get new episodes. Also, visit our website, sign up for our weekly newsletter to get notified with an email every Thursday when those episodes drop with some nice show notes and links and stuff.
That's right.
So check that out. So today, it's big news, Josh.
Yes.
Everyone's talking about it, so we're going to talk about it. Silicon Valley Bank, how it failed, and what you need to know as an investor and consumer. So there's a lot to talk about today. So this is the second largest bank failure in U.S. history.
Yes. So Silicon Valley Bank had $209 billion in assets at the time of the failure. And so that makes them the second largest bank in U.S. history to fail. They're second to Washington Mutual, which failed back in the 08-09 financial crisis. They were early in that. That's kind of what was the springboard for a lot of this issues. And they had $307 billion when their bank failed.
Absolutely. So let's dig into what happened.
Yes.
So firstly, it's important to understand that Silicon Valley Bank didn't really fail in the terms that things in 08 failed.
Yes. It was a different type of
failure. Really, in 08, it was about loans. A lot of it was bad loans, over-leveraged
different
loans.
type of failure. It's like when you're coaching a team, you're like, they scored more than us. We just didn't score enough.
That's right.
I don't know.
That's
like,
exactly.
Our defense was great, but our offense was not good. Different type of failure.
So typically when you think of a bank failing, you think of what happened in 08.
Yes.
You think of loan losses.
They did bad loans.
Driving what's happening with these banks. But in fact, loan loss reserves, which are reserves money set aside by the bank to cover losses on loans, that was only 0.86% of their total loan portfolio,
0.86%,
which is a really, really low rate. And in fact, it's just crazy for a bank of that size to have such low loan loss reserves, but they didn't have bad loans. That wasn't the issue. They're not sitting on a bunch of bad loans. They also were not heavily leveraged. Another thing that happened in 08. These banks were heavily leveraged.
Yes.
So they were very much extended, indebted, and then when it came time to pay the piper, well, they were underwater, right? That's what happened in 08. Well, this bank was only at 13-to-1 leverage. So that's looking at assets to equity, comparing assets to equity there, which is not an extreme amount of leverage when you look at banks. They were much higher when we ran into those issues in 2008, 2009. So what did happen was that Silicon Valley Bank was a victim of its own success in the zero interest rate world that they were in. So what happened was their business was all about locking in tech employees, tech startups, tech founders and leaders, giving them commercial and personal loans if they agreed to bring the majority of their cash and business requirements to Silicon Valley Bank. So they were trying to just get in the system, right? And they were completely ingrained in the tech system in Silicon Valley and made a lot of deals out there. But it wasn't all about lending as much. It was just being the go-to bank for tech. So not crazy leverage, not sitting on a bunch of bad loans. But what we must remember during this zero interest rate world that we've lived in for a long time is that there was a lot of money in Silicon Valley. A lot of easy, cheap debt, cheap cash, cheap money. And that's not exactly the world we live in now. But for the past decade and a half, that was the case. So there was a lot of cash that was funding startups and venture capitalists, and tech employees were making big money. The interesting thing here is that all these companies and people, they were putting their money at Silicon Valley Bank, not all, but a lot. 93% of the balances at this bank were uninsured, and that means that they were in excess of the $250,000 FDIC cap of protection.
Now, that seems high. And I'm assuming most banks don't see that. You probably don't have 93% of your balances above 250.
True.
So, yeah, that's crazy.
And they were trying to get you to bring all of your money there. That's kind of how it was.
But they're probably paying next to nothing.
They were for a long time.
Yeah, that's crazy.
Maybe slightly more than next to nothing just to attract more people.
But still crazy.
But they wanted to be the one-stop shop for tech, and that's kind of how that happened. So think about this. They had billions of dollars of cash deposited, not paying a whole lot on it because they didn't have to. Right. Interest rates were low. But they wanted to earn more than they were paying out on that money. So what do? You got to buy something.
Yeah.
You got to spend money to make money. So you're going out and you're taking your customer pool of cash. This is a legal, ethical thing that all banks do.
Yep.
Taking your
and
pool.
they bought Bitcoin.
Yeah, they bought Bitcoin. No, they actually took it out and they bought bonds.
So they're being prudent.
Right?
Yep.
Bonds aren't risky.
Mm-hmm. Yes.
We're going to get to that, talk about last year, but they bought interest-bearing bonds. So at the peak, the deposit pool was worth about $200 billion. Which they then took that $200 billion. They went out and bought $128 billion.
So they kept some in cash, which is what they need to do. Banks are required to do.
Yes, there's a liquidity requirement there. And they went out and bought a big bunch of bonds with that. The vast majority of securities purchased with the inflows were long-term bonds. Long-term bonds are the most interest rate sensitive bonds, by the way.
They struggled in a rising interest rate.
You really should not be putting I actually saw a breakdown of maturity, duration of what we're talking about here, and like different banks' portfolios, and theirs is way longer.
Yeah, they were going long,
which means that they were most impacted by price.
And holding to maturity means they're planning on not getting that money back for a long time.
Yeah, exactly. Yeah. It's supposed to be a 20-year bond, 30-year, 10-year, whatever you're talking about, it's long. So anyway, they're planning on holding these to maturity, but what's interesting is that on your bank's balance sheet, bonds that they're planning on holding to maturity are not marked to the market. So Josh, talk a little bit, just briefly, 5 seconds on mark-to-the-market accounting.
Yeah, so what that means is, and this is really coming out of the 08-09 crisis, is where this came to, is for a long time, you had a lot of these assets that if you couldn't adequately price on an ongoing basis, you would say, here's what I paid for it, and you would just leave that on your balance sheet.
Right.
And you would say, I'm not going to adjust the price or the value of it, because I don't care. I'm going to wait until the end. Matured. So again, if we're talking bonds here, and these are what banks are holding, is if I bought a bond for $1,000, I would on my balance sheet say, I have a bond for $1,000, and I'm getting interest on that. But the liability there is I gave up $1,000 for a while. It's no longer available to me to use for my deposits or anything else.
You're going to get $1,000 for it at the other end.
Since it's held to maturity, I'm planning on I'm going to get back my $1,000 in my example, plus whatever interest I collected along the way.
Yep.
So it's not like they were trying to hide anything. When you're planning to hold to maturity, the fluctuation in value is irrelevant because I'm going to get back my face value of that bond that I purchased. So that's what they're doing. Mark to market says, at least at some periodic interval, I need to adjust the price based on what currently is, so that if there was a need for it, I would know exactly what I could get for it. Yeah. So in a good market, if it goes up in value, I would mark to market. Now I have a appreciation. Right. That's a good thing.
Right.
In a down market, I would have value or adjust it down. Yeah. Again, my example, put $1,000 in, I bought this bond, interest rates go up, bond prices go down. Now I have a $900 asset when I paid $1,000. So I'm down $100, but again, I'm holding to maturity. So that's just a adjustment to the value, even though I'm going to get my $1,000 at the end. So mark to market is just adjusting the value interim. That didn't change their intent. It just changed the asset's value on their balance sheets.
Now, what we're going to dig into shortly is the impact of the mark-to-market accounting and what that took bond value to. Okay, so we're going to get to that in a sec. But here's, essentially what happened here. So the combination of rising interest rates, which you just alluded to, lower bond prices, we saw that last year. And
let me explain that too. So if I have a bond, let's say it's a 1-year bond, and I'm going to use round numbers just for easiness, and it's paying 2%.
Yep.
All right. And I bought that in January. And then a month later, a new 1-year bond is coming out because interest rates went up and now it's paying 4%. My bond, if I went to sell it, why would someone want to buy something yielding 2% when you can get a new one for 4%?
Right.
That's why bond prices go down when interest rate goes up, because now I got to offer something to entice people.
Which is a discount.
Which is to discount what mine is worth. Yep. So now maybe I will pay less for lower interest rate, but then I have more cash to buy things with.
So another example of that is how inflation impacts bond prices. So we're in the process of phasing out, we're coming down off of inflation. We're still in an inflationary environment, but last year inflation was very, very hot, 2022. So if you think about bonds are a fixed income security, right? So you are receiving a fixed income for the locked up capital that you've lent to whoever you're lending to. So what happens is when inflation is hotter, that means that your fixed income piece is a lot less attractive.
Yes.
So if your income's fixed, that's not going up to counteract inflation. So people were selling bonds all this whole time last year, which is one of the reasons interest rates shot up so much. So that's the two sides of that same coin is what happened to the market we're in. So you combine rising interest rates due to high inflation, the Fed, all those things causing lower bond prices and negative bond returns, which meant lower value of bonds on this balance sheet specifically, and falling deposits because, money became a lot less easy. Startups and venture capital firms, they were a lot less itchy to have a bunch of cash and to be depositing it at a bank like this.
Combine and you saw layoffs in the tech industry at the end of last year, early this year, all the way through. And so that's causing a slowdown in general.
Absolutely. So if you combine those two pieces together, that means that Silicon Valley Bank had to sell some of their bonds they were planning on holding to maturity before they were matured, essentially locking in losses. So that's exactly what happened. So this really caused them to have more deposit outflows and eventually their failure. Now, I will note that on Monday, March 13th, 2023, which is actually the day we're recording this, insured depositors, which are those holding $250,000 or less, will be able to transfer balances to other financial institutions. But what will other, those holding in excess of the FDIC insured $250,000? Now, what are they going to get? Here's really the nuts and bolts of it is, I'm just going to make this pretty high level.
Yes.
At the end of 2022, the company, Silicon Valley Bank, in their 10K, on page 125, if anyone's interested.
I was almost to there. Okay.
Yeah, exactly. They had 17% losses for its held to maturity securities. So 17%. Call it 17, 18, kind of in that ballpark. So at the end of the day, you're locking in a 17% loss if you have to sell all those assets, but you're going out of business. Someone's buying them, you're going to have to sell them. As long as Silicon Valley Bank's loans are worth at least 82, 83 cents per dollar, depositors are essentially going to get paid out in full at some point. It will take time for all of this to work out. That's just the key right there. It's really estimated, and this is a number from a data provider called Bespoke that we subscribe to here in the office. It's estimated that roughly 2/3 of deposits look certain to be recovered. That's really good, 2/3. With another third of that extra 1/3 that are left, quite possibly recoverable. There may be some losses out there still, and that is just the risk of the space. So, in a nutshell, that is where we are today.
And tell me, the Fed is saying everybody in FDIC is getting their money back. That's what the insurance is for. They're trying to get all the stuff above that as well.
Yeah, and I'm going to get to that.
Good.
After your dad joke of the week.
Okay, good. All right, dad joke. So I wanted to find a bank one, all right?
Take that to the bank.
Yes. So have a friend, bank teller.
Do you actually, or is this just a joke?
This is a joke.
Okay.
He lost his job the other day.
Oh, man.
Yeah,
Did he work at
He was not there.
Silicon Valley
It was for a
Bank?
whole nother reason. He lost his job because this lady asked him to check her balance, and he pushed her over. And I think he was confused with what she really wanted. So she was not happy about that.
Yes, be careful what you ask
Different
for.
balance wanting to be checked.
Exactly.
So there you go. There's my bank joke for you.
That's a good bank joke. So let's talk about some other interesting comments about what is occurring here, because there are some nuances that I think are worth pointing out. Number one, the bank closed in the middle of a day. Like, while it was trading, middle of a business day. That's unusual.
Lock the door.
Usually these things kind of happen, A, over a course of time, or B, like on a weekend or something like where they're not business open. But yeah, happened in the middle of the day, very unusual. Another note, at the end of 2022, Silicon Valley Bank only offered 0.6% more on deposits than its peers, but that does not really take into consideration the risks that were out there that the people who were depositing with them really did not think about, clearly. But despite this, many companies held way more than their insured amount. Now, in 2021, that premium was only 0.04%. So small.
Yeah.
And yet, people are taking billions of dollars to them.
Yeah.
That's crazy. Another thing, they were kind of on their own in terms of the level of their loans plus securities as a percentage of deposits, which really meant that they were not very reliant on retail deposits because of the way that was there. So they're niche. They were a niche investor with Silicon Valley and tech as their, kind of mantra. That's all they were going for. They were going for big tech. So they set themselves up for a large potential capital shortfall anytime interest rates went up because of how risky and long duration their bonds were, which was something that was a big problem for them. And again, as a point that we're going to continue to make, this did not occur due to credit risk issues. In 2008, we were living through a financial crisis that was due to credit issues. This is an interesting one that is not. It's all about a mismatch between really good assets and liabilities and investing that capital in a way that was inappropriate.
Yeah. Yeah, because really the bank, although there was a drop in value, they hadn't really lost any money with their goal being to hold maturity.
Right.
They just lost their cash flow because there was higher withdrawals than they were bringing in.
Exactly.
And they had to sell to get to the end result.
Now, what's interesting is if you think about how this all occurred and how this money became a behemoth and really did well during this period of zero interest rate. That was where they were getting easy and fast cash and loans and money for venture capitalists and tech firms and all this stuff. Well, they were thinking they were riding high on the horse, right? This was as good as it could get. But at the end of the day, monetary policy tightened up and now they're out of business. This proves that this zero interest rate world and really loose and easy monetary policy actually ended up being more of a curse for the company than it was a blessing.
Yeah.
Here's another interesting one. According to Fortune magazine, Silicon Valley Bank's chief risk officer left the company last April and was not replaced for 8 months.
Oh, man. Like end of last year.
And so this whole year they're going without a chief risk officer, obviously having a lot of risk on their balance sheet.
Apparently.
This is a big risk. So that's interesting and noteworthy. And another one is that there's a stable coin. So stable coins are essentially cryptocurrencies that are meant to hold a stable value, right?
Okay, which they don't. But go ahead.
They often don't. So there's a stable coin called Circle. So Circle reportedly has $3.3 billion of its $40 billion in reserves tied up in Silicon Valley Bank deposits. So this is really part of a broader issue about the cryptocurrency space where they don't necessarily have to have fully audited disclosures on their reserves. And this could be a big issue. Like if you're trying to withdraw your Circle, you may not have access to it because it might be tied up to cash that's inaccessible.
That's crazy.
Craziness. So we're going to talk about economic impacts of what's going on right now. So number one, the Fed obviously is driving a lot of this because their zero interest rate policy on one hand caused a lot of this, and their tight monetary policy stance today really just put the nail in the coffin of what's happening.
Do you think this was anywhere in their considerations when they were raising interest rates to counter inflation that they considered the financial sector and banks holding bonds?
I think so, but they would point to the fact that they make banks do stress tests a lot.
Yep.
And I think they would also point out that the vast majority of large U.S. banks perform very, very well on stress tests. That being said, I think the Fed has been willing to go tighter and tighter and tighter in their monetary policy stance until something broke. Guess what just happened?
Yeah.
Something finally broke. We were waiting on something to break, and something breaking is what really probably was going to tell them, okay, well, I think we're pretty darn close to where we're going. So let's talk about what the markets are pricing in now.
Yep.
So, yes, they broke something. And in fact, they already stepped in, and you were talking about this earlier, but they stepped in with a loan program to inject new liquidity into banks facing similar problems.
Yep.
So smaller banks, generally speaking, who have these similar liquidity positions, there is a special loan program that just got released on Sunday night where based on if you meet these certain criteria and yada, 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 you can go take advantage of very affordable loans to be able to meet your withdrawal requirements. It's just so this sort of thing doesn't continue to happen and become a contagion.
Because again, we look at Silicon Valley Bank, they had the assets. They just were down in value at the point where there was an increase in withdrawal requests. And so what the Fed is setting up is saying, hey, so you don't have to sell all these things that were supposed to be long-term maturing. You're doing a prudent job.
Yeah.
We raised interest rates quickly, which caused those longer-term bonds to really adjust in price.
Yep.
we will give you a program that, in a sense, we're just going to give you liquidity. When those mature, you can pay us back. Everybody's happy. Good to go.
Try and keep things afloat. Now, I will note that this is not a bailout for Silicon Valley Bank.
They're done.
They have messed up.
And they're done. Yep.
In fact, other banks are vultures right now, trying to buy up all these loans and everything
because
they
good.
hold because they're pretty good and they're at a very big discount right now. So I know like Goldman Sachs just bought $2 billion of loans off their balance sheet because it's a great deal. Take advantage of it while you can. So that's interesting. So let's talk about the impact of Federal Reserve interest rate policy. So interest rates dropped late last week on really economic fears because, hey, the financial system's breaking, right? The market went from pricing in 3 rate hikes and then holding the rest of the year to actually maybe about 1 hike now. Only about 1. And that's not even a given. You could have none. And in fact, in the morning of Monday morning, it was actually like almost a coin toss on whether you'd have none or 1.
Okay.
Craziness. It's actually leaning more towards 1 now. And actually pricing in up to 2 to 2.5 cuts by next January again.
So, and there was none for a while.
Nope.
Right?
And we were talking about cuts for a while. Then it was nope. The market finally got to the point where we're not talking about cuts. Now we're talking about cuts
back up again.
Here's another opinion of mine. Liquidity in general right now, as we're finding out through this story, harder to come by for startups, harder to come by for venture capitalists, those sort of things. A bunch of cash, easy, free money, those kind of things.
Yep.
In my opinion, this is actually semi-bullish for things like mega cap tech. Not a recommendation to buy it, but these companies have a lot of cash on hand. Hopefully they've diversified themselves.
Okay, where's your cash?
Yeah, where's your cash? But they're not going to be competed with as much by new startups. So that's so super interesting in the way that this is playing out. Here's the question for you, Josh. Are we in another financial crisis?
I don't see it. My opinion is that the Fed stepped in very quickly. I mean, it was the weekend. They didn't take time to think about it. They said, you know what? The banking sector, which is the lifeline for our economy, when it comes to if people are worried about cash flow, everything has a problem. That's what we saw in 08, 09. We even saw that during COVID, is that when they were worried, I can't get cash, then there was problems. And the Fed stepped in and said, look, we're going to keep that going. We're going to make sure banks have the liquidity they need. So I think they got in front of a big financial crisis. Now, could this be the catalyst for a recession or a downturn? Possibly. But I think they got in front of like a full-scale financial crisis because really, like you said, it's that domino effect of not just this bank, but what if it continues on? Because if people get scared and they go to their local bank and they kind of get this snowballing effect, that's the problem. Yeah. So I think the Fed did their best job they could to get in front of it and say, hey, look, we have this loan program. Banks are fine now. Yeah. Right? This one's it's going to be dealt with, but in general, nobody else is going to struggle as much now because they have another option of getting cash. Yep. So I think that helped. Your thoughts?
Yeah, I don't think it is to the level of a financial crisis at all. I actually think that if you look at almost every bank has bonds at losses on their balance sheet right now. However, most banks did a much better job, and we can see this by the duration in their portfolios, of managing interest rate risk better than Silicon Valley Bank did. Yeah. So I feel like overall, there may still be some smaller banks to go under. I think things are going to be in a good position, and I actually think that the capital and liquidity requirements and capital ratios of some of the largest banks, JP Morgan's the largest one in the U.S. It's not, again, not a recommendation, but it's one that comes to mind. I've seen some of the numbers, even taking into consideration some of these losses on the balance sheet. Their capital ratios are fantastic. Yeah. Things like that, I think, are going to remain pretty stable. I'm optimistic that this remains contained, which is good. Yeah. So now we talk about what's going on in the markets here, obviously. So things have moved. Equity markets sold off rather sharply.
Friday was rough.
Well, really, the whole end of the week as this was working out was rough. Ironically, on the other side, bonds did well. People bought bonds. They were scared. Sold stocks, bought bonds, and interest rates went down, right? Price went up. So bonds did okay through all of this. Some interesting areas of note. Smaller regional banks were some of the worst positioned, and we just talked about that. But they were sold off worse than the broader market. Small caps in general, if you look at like small cap indices, they underperformed large caps because banks in small caps actually represent like 25% of the Russell 2000. So small caps underperformed large caps, and that is something that could continue as some of this choppiness occurs in this area specifically. My opinion in the market right now is that I expect volatility to continue.
Yep.
Specifically in equities, although we've seen this has had upside volatility impact in the fixed income markets. So if this continues to show up as risk and as economic deterioration, bond yields will come down and prices will go up. That could be bullish on a volatility side for fixed income.
Yep.
But this is really going to just wreak havoc on certain areas of the stocks, because you're going to have news one day where it goes one way and the other day it's bad and then it's good again, and the Fed stepping in, so that's super bullish, because obviously when the Fed steps in, the stocks go to the moon, zero interest. But that's not always the case either. So I just can see it going both ways, which is why I say volatility. Any thoughts on where the market's headed here?
Oh, I have no thoughts on that. It's unknown. Yeah. But what you saw over the weekend, and even, for instance, Monday morning, when I came into the office, I think the Dow was down 400 before the market opened flat, was up, and then closed slightly down for the Dow. So it's all over the place as people are digesting this. Now, the answer is there's volatility, and until this plays out completely, I think there's going to be some volatility. Yep. But again, the long term is, like we've always said, Austin, is you stick to a plan. You have an idea of what you're doing and why you're doing it. Volatility is going to be here. Yep. And this just is one more reason for people to react.
So that brings me to my last discussion, Josh, and this is where you come in.
Yes.
As my go-to guru of financial advice. What do you need to know? What do our listeners need to know as a consumer and as an investor right now?
So when it comes to banks, there's FDIC insurance, and you're protected for bank failure up to $250,000 per person. And there's different caveats to that when it comes to trust accounts and all this fun stuff, joint accounts, all those things. But $250,000 per person is what you need to know. Anything above that is not guaranteed or insured. And so
at one location or at one institution
per bank.
Yep.
And so keep that in mind. If you have a lot of cash, spreading it out is beneficial from that security standpoint. When it comes to investing, there is SIPC insurance, which is Security Investor Protection Corporation. And it's a similar type of insurance. This is actually a nonprofit corporation created by Congress to do the same thing. So it protects brokerage accounts, investment accounts, similar to this, in that if there's a failure in that custodian or institution, then you have up to $500,000 insured. $250,000 of that is for cash or money market. Not for losses in investments. Right. It's not insurance against, the market went down, I lost money. No, it's if there's a failure for that. Same idea though. Custodians can actually have additional insurance up to higher amounts, but in general, there's a protection there as well. The key, though, is understanding what you're doing with your money and where it is at. Look at the bank. Now, people have a hard time understanding those balance sheets. You look at it and say, well, $100 billion in bonds, that seems pretty secure. Understanding that, but being careful, making sure you trust where you're putting your money is very important. But in the end, having a plan is huge. Being liquid with assets to cover what your short-term needs are, and then taking longer-term risks with your assets that you have time to let it grow. In other words, making sure you can get to the cash that you need for your short-term cash flow, your normal monthly needs, emergency funds like that, and then stepping out on the risk for the things that you have a little bit longer duration for. If you do that, then these type of issues really aren't as big of a concern as long as you're invested in high-quality things. Long-term, that's where you grow your money historically. If you have concerns or questions or want to know how that impact is, reach out to us. The email is hello@theinvesteddads.com or the investeddads.com website, and we'd be happy to talk with you about that.
Thanks again for being here. Yes. We'd love it if you'd share this episode. Maybe someone you know is asking, what's going on with Silicon Valley Bank? Well, here's a one-stop shop where they can hopefully get a little bit of closure on what's going on there. And again, as a reminder, we'd love it if you subscribe. Right. New episodes out each and every week, and you get them first. And leave us a review on Apple Podcasts and Spotify. So until next Thursday, have a great week.
Talk to you there.
Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review. Click subscribe and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.